The markets are closed. The trading floors are silent, eerily silent. But right now, behind sealed doors at the Federal Reserve, inside the Treasury, and within the private offices of the most powerful financial institutions on Earth, a conversation is happening. One you were never meant to hear. They're not talking about the past. They're talking about Monday morning. About whether a financial system that barely reopened last week, held together by a fragile ceasefire, can actually survive when trading resumes, or if it begins to fracture. They're dissecting the last 6 weeks, events that don't just happen. A war with Iran sending oil to $126 a barrel. A bond market sell-off pushing the 10-year yield to 4.44%. The S&P 500 posting its worst quarterly performance since 2022, down 4.6%. And now, the Federal Reserve is trapped, paralyzed between inflation and recession. A 2-week ceasefire, signed on April 10th, one no one truly believes in, has forced central banks into a position they've only faced 9 times in the last 4 decades. What happens next is everything. Activate the weekend protocol. This is the mechanism almost no one talks about in normal market conditions. It's the playbook the Federal Reserve turns to when a Friday close carries so much systemic risk that waiting until a scheduled Tuesday press conference is no longer an option. This is where it happens. A coordinated system of tools, back channels, and emergency procedures designed to push out policy changes, inject liquidity, and align with the Treasury and global central banks before the market even has a chance to open on Monday morning. It's been used before. It will be used again. And right now, April 2026, every single condition that has ever triggered a weekend intervention in history is present at the same time inside the US economy. By the end of this video, you'll understand exactly what those conditions are, exactly what the Fed's historical weekend playbook looks like, exactly which signals to watch for this weekend, and exactly what it means for every asset you own if that announcement hits before the opening bell on Monday. This isn't speculation. This is a documented pattern, how the most powerful financial institution in the world operates when it's cornered between conflicting mandates and a market that cannot absorb another shock. Start with the mechanism. There's a 4-stage framework that explains every major weekend move the Federal Reserve has made in modern history. Stage 1, pressure builds. Multiple systemic stresses stack over weeks or months. None are fatal alone, but together they create fragility. One more shock and the system cracks. Stage 2, the trigger. A specific event, a market close, a data point, a geopolitical shift pushes risk into full instability. This is when the Fed realizes waiting is no longer an option. Stage 3, the weekend window. From Friday's close to Monday's open, the Fed moves, not because it prefers weekends, but because it's the only time to act decisively without triggering immediate panic. You don't deploy emergency policy mid-trading. The weekend is the only controlled environment to prepare the medicine before the patient reacts. Stage 4, the Monday announcement. Rates cut, liquidity injected, coordination deployed. The market opens into a new reality. Those who understand the pattern position early. Those who don't react late. That gap is where fortunes are made or lost in minutes. We've seen this before. March 14, 2008. Bear Stearns was collapsing under $74 billion in toxic mortgage exposure. Contagion risk was exploding. If markets opened Monday with the truth exposed, panic would spread instantly. So the Fed activated the protocol, emergency meetings, weekend intervention, history in motion. By Sunday night, the Federal Reserve had made its move. It agreed to backstop Bear Stearns' toxic assets, clearing the path for JP Chase to acquire it, for just $2 a share, a fraction of where it traded days earlier. Before Monday's open, the deal was announced. At the same time, the Fed cut the discount rate by 25 basis points, sending a clear message: they were all in. Markets opened into a new reality. Not a good one, but a known one. Panic was contained. The system survived Bear Stearns. It wouldn't survive the same mistake 6 months later with Lehman Brothers. Fast forward to March 2020. Markets were in free fall. Liquidity was vanishing. Even in treasuries, a $1.5 trillion Friday injection failed to stabilize the system, so the weekend protocol was activated. On Sunday, the Federal Open Market Committee slashed rates to near zero, launched $700 billion in QE, and removed reserve requirements. Jerome Powell made it clear, every tool was in play. Then Monday came. A zero-rate world, a fully deployed Fed. Those who understood the pattern were ready. Everyone else reacted. Go back further, 1987. Black Monday. The Dow collapsed 22.6%. The system itself was at risk. One sentence from Alan Greenspan. A promise of liquidity was enough to stop the collapse from becoming systemic. Not action. Credible action. That's the protocol. The market stabilized. The system held. And every investor who understood one thing knew exactly what had just happened. When markets close on Friday showing signs of systemic stress, the real decisions are made over the weekend. Positioning for recovery, not collapse. That's the power of the weekend protocol. That's why it matters. Proven. Undeniable. Now apply that framework to right now, April 11th, 2026. The same conditions that triggered past interventions are aligning again. First, technical weakness. The S&P 500 just posted its worst quarter since 2022, down 4.6%. Still trading well below its 200-day average. Volatility is elevated. Structure is fragile. Second, ceasefire risk. A 2-week agreement with Iran sparked a rally, but history shows these are the most dangerous rallies of all. They rely on trust, and that trust is already cracking. Any breakdown this weekend could reverse everything by Monday. Third, internal paralysis. The Fed is divided, uncertain, and openly acknowledging stagflation risks with no clear policy path. Fourth, leadership transition. With Jerome Powell nearing the end of his term and a new doctrine approaching, markets are trying to price two completely different futures at once. Pressure is building, and the weekend is where it breaks or is contained. We are entering the final phase of Powell's tightening era and the beginning of something far more unstable. Policy uncertainty itself has become a source of risk, and historically, this is exactly when the Fed is forced to act between meetings to anchor expectations before instability turns into crisis. Now look at the bond market. Yields are surging. The 10-year jumped from 3.97% to 4.44% in under 30 days. The 30-year is pushing 4.9%. Treasury auctions are weakening. Dealers are absorbing double the normal supply. That's not noise. That's stress. At the same time, reserves are approaching a critical floor. The Fed knows it, they've said it, and they're preparing for it. But here's the key. This isn't a collapse scenario. Markets have stabilized on the surface. The ceasefire sparked a rally. The S&P 500 rebounded. The system looks intact, but underneath, it's fragile. A 2-week ceasefire no one trusts. Rising yields signaling inflation and uncertainty. A leadership transition the market cannot price. This is not a system in crisis. This is a system in balance, barely. And that's exactly when the weekend protocol matters most. Because intervention doesn't always mean rate cuts. Sometimes it's liquidity. Sometimes it's coordination. Sometimes it's a signal just enough to prevent chaos before Monday opens. The goal isn't to save stocks, it's to save the system. The biggest misconception right now, that nothing can happen until the next FOMC meeting. That's not how this works. The Fed doesn't wait for the calendar when conditions demand action. And the March minutes made that clear. They need flexibility. In central bank language, that means one thing: act off schedule if necessary. Look at the setup. A fragile ceasefire already being tested. Inflation data about to reflect a full energy shock. Reserves draining into a known April low. And a bond market flashing early warning signals. Yes, the next meeting is in 17 days. That's the plan. But the weekend protocol? That's the contingency, and it's been used 9 times in 4 decades. So what actually matters right now? First, don't misread the risk. This isn't a system in free fall. The rebound is real. The S&P 500 has recovered. Momentum has shifted. But the real danger isn't the rally. It's the fragility underneath it. Second, watch what comes next, not just this weekend. The PCE inflation report will be the first true read of the oil shock. That's when risk escalates. Third, the bond market leads everything. Not stocks, not volatility. If the 10-year yield breaks above 4.5%, pressure accelerates fast. Fourth, understand the transition. Jerome Powell is heading into his final meeting. The next regime is already being priced in, and that shift alone can move markets violently. Fifth, have a plan for both outcomes. If the ceasefire holds, recovery continues. If it breaks, everything reverses fast, because the investors who win in this environment don't predict, they prepare. The weekend protocol is real. Pressure builds. A threshold breaks. The window opens. Monday arrives, and the market is different. And in a world this fragile, the weekend isn't downtime. It's where the future gets decided.